Well, Wall Street, of course, ending lower in trade, led down by retailers and small caps. Let's get some more on the moves. Larry Shover, Chief Investment Officer at SFG Alternatives, joining us live from the CME Group in Chicago right now. Larry, great to see you as always. Just in terms of the overall market, it did seem to be quiet though in terms of the volumes. Is that the sense you got as well? And why is that?
It's been that way for a while, just aimless, directionless trading, light volume, thin liquidity. Right now, the S&P 500 seems very content to remain between 1840 and 1880. There's been very few exceptions of that. And until further notice, until there's a game-changing narrative, we're going to be stuck in this stock market ice age that's, I compare it to like 1994 or 2004. We just sat still for a very long time.
How long do you think this could go on for?
It could go on for a lot longer than we could stay solvent, that's for sure. I mean, right now we need a narrative, and we're assuming that the central banks are coming to the rescue for Europe. We're assuming we're going to see growth. And one thing that we're really assuming has been good is that global inflationary data will continue to creep its head on the upside. As you know, we've been in a 3-year downward disinflationary period. So we're assuming all these things. We're in a growth mode. It's okay to digest and consolidate for a while. Yeah,
just on the small caps, the moves there, obviously the sell-off in recent months, again down overnight after, a bounce back in the previous sessions. I mean, what do you see happening here? Is there a bottom forming?
I'd like to think so, but let's remember there's two things going on, or at least I think there is. And one is that the Russell 2000 was up about 37% last year. And so right now, the market just might be recalibrating on what stocks people want to own, what stocks they don't, people getting a lot more choosy. And also, another thing we should be mindful of is that this trend of underperformance has only been happening since March. And I'm talking about underperformance relative to the S&P 500. Yesterday was an outlier in that we saw outperformance of the Russell 2000. But by and large, I mean, this could happen for a while until the economy and the traders in the economy just recalibrate their thoughts on what groups they want to own and what's the least risk they want to take right now.
I just want to ask you too, because we get the Fed minutes, and there's been a couple of Fed speakers overnight, including Dudley, which really seemed to be a focus for markets.
Yeah.
Just again, this idea that the Fed's rethinking its exit strategy of how it ends QE and starts to raise rates.
Yeah, I think you're right. I don't think the consensus is looking for any fireworks tomorrow in the U.S. I think it's more about logistics, as you mentioned, not about timing. I think what people are listening and looking for is any narrative with regards to our housing industry, our housing market, because as you know, it's stuck in the mud just a little bit. And will there be any contingency plan or any hint of a contingency plan for our housing market? I think that's the only thing that could really move the market tomorrow.
And just in terms of the other data as well this week, obviously we get flash PMIs, US, Europe, China.
Yes.
Just how important is that going to be? What are you looking for?
I think it could be very important, and maybe that's one reason why traders are really sitting on their hands right now. I mean, we have the flash PMIs, as you mentioned, come out Thursday. We also have existing home sales on Thursday, new home sales on Friday. That's in the U.S. On Friday, we have the IFO survey coming out of Germany. That all of a sudden is becoming very important because if you remember a couple weeks back, the ZEW, the ZEW survey, was a lot softer than expected. So I don't think any of those would be game-changing for the stock market. However, all combined, you just never know.
And just in terms of the moves in bond markets as well, that's been really interesting. And again, the 10-year yield coming down to around 2.5%. And, it's certainly obviously a big focus for markets. Where do you see that going? And I mean, do you see this rally in bonds coming to an end anytime soon?
Well, it seems the obvious answer is that the end will come on June 5th because everybody's expecting the ECB to take action. What kind of action they're going to take, it remains to be seen because the market is clearly asking for asset purchases, and I'm not sure how Draghi will pull that off. I can definitely see him suspending S&P sterilization, LTRO. It's a foregone conclusion that they're going to lower rates 10 to 20 basis points. So all that said, the reason why the U.S. 10-year yield, in my opinion, is down to 2.5, it's really just an arbitrage opportunity where our bonds look very attractive when you consider Ireland's 10-year yield is 2.6, Italy is 3, Germany is 1.3. Put that all into perspective. That's the reason. It's not a reason that anybody saw beforehand. It's more after the fact. So could rates go lower? Absolutely, they could. And it seems like that's the least path to resistance right now. But June 5th will be a real truth teller.